Investors Chronicle.
Hello and welcome to IC Interviews. My name's Faith Glasgow. With me here today in the studio I have Jon Forster. He is the manager of Impax Environmental Markets, which is the largest investment trust focusing on the environmental sector. Jon's worked at Impax since 2000, and since 2002 he's managed their flagship Impax Environmental Markets investment trust with Bruce Jenkins-Jones, and more recently with Fotis Hadjimikalakis. The trust focuses on environmental and resources efficiency markets, looking to invest in companies that produce measurable environmental benefits and solutions, and it has been picked out as one of the best examples of a genuinely sustainability-focused fund. To start with, Jon, welcome. Perhaps you could tell us a little bit about how you came to be doing this job in the first place.
Right. Hi, Faith. Thanks for having me. So how did I come to be here? I studied German and management studies at university, and part of living over in Germany, I think they were at the forefront of environmental markets growth. So I'd experienced environmental markets up close. When I finished university, I'd ended up in the city doing mainstream investment banking. And after a few years of that, I really wanted to specialize in an area and become an expert. I wanted it to have attractive growth, and I was hoping the companies would be doing good things rather than bad. So that was the exploration that landed me on Impax's doorstep those 22 years ago.
Gosh, so it's been quite a journey since then. So could you tell me something about the term environmental markets? What does that encompass these days? Because 20 years ago, it must have been a very different kind of market that you were looking at.
Yeah, that's right. I mean, it's changed a huge amount. I mean, just to be clear, environmental markets we see as being markets for the cleaner, more efficient delivery of basic needs. So if you think about energy, food, water, these kinds of things. And they're also about addressing environmental problems. So obviously climate change, pollution, plastic waste, these kinds of areas. So that's what these markets do. But the opportunity set, when you start talking about sectors, has completely transformed over the years. And when we launched in 2002, we had really kind of three sectors: alternative energy, water, and waste. And we had a very small universe of 250 companies, a lot of them speculative, unprofitable alternative energy names. So if you roll forward to today, it's completely transformed. We're now looking at new energy, clean and efficient transport, sustainable food, water, circular economy, and smart environment. And the universe has grown to 1,400 companies. So it's a much larger, richer, more diverse investment opportunity than it was back in 2002.
And these are presumably profitable companies now rather than kind of startups.
Yeah, exactly. So I mean, these, what was quite a niche speculative opportunity is now very much a large mainstream investment opportunity, and they're markets that are served by large mainstream proven profitable businesses. Exactly.
Could you say a bit more about the key areas where the portfolio is focused?
Well, we're decently diversified across the sectors that we've just mentioned, but to pull a couple of examples out, we've got good exposure to what we call energy management and efficiency. That sits in the new energy bucket, and it's all the energy efficiency opportunities. So if you think heat pumps, efficient lighting, backup power, industrial software, all of these kinds of opportunities would sit within that area of opportunity. And then secondly, if you talk about circular economy and waste management, we've got investments in hazardous waste companies, which are very highly regulated. And within circular economy, there's a whole range of opportunities, everything from product design software to natural ingredients and sustainable materials, to sharing economy business models, to then recycling at the end of the product's life. So we're investing in the full circle of that.
That must be a really interesting, rapidly evolving area of work, I should think.
Yeah, it is. I mean, it's the circular economy, I'd say, is very early days in being fully kind of embodied in the global economy. We've been recycling beverage containers for a long time, but actually fully integrating this across industries and through the whole life cycle of products. I think that's very early days, and that's something we're quite excited about.
Yes, I can imagine. What are the considerations that you have to take into account when you're assessing companies for the portfolio? What primarily are you looking for?
The prime focus of the trust is performance, right? We're looking to deliver the best risk-adjusted performance for our investors. So we're really looking for companies with strong fundamentals, attractive market position, technology, a strong business model, management, attractive valuation, the full suite of fundamentals. So that's our primary focus. But part of that assessment is ESG analysis, right? So that's the other side of the research, and different investors see it in different ways. But we see it as a really good investment tool to identify quality and also manage risks in companies. So it's part of the research process. And if you look at it in both directions, from a quality perspective, good companies are good all the way through. They have good governance. They comply with all the environmental regulations. They manage their relationships with their stakeholders, their staff, their suppliers, etc. So that's on the good side of things. And likewise, if a company is not doing all of these things, then in our industries, and I think in every industry, that's eventually is going to hurt the financials. So that's how we see ESG as part of the research process. I guess the other thing is impact. I think the way to position it is it's an outcome of an investment rather than an objective. So we're looking to deliver performance, but our companies are pure play environmental companies that are delivering a significant net environmental benefit. So that's an outcome of an investment, but not something we're focusing on as a priority for our investment.
I mean, you've mentioned the focus on quality and growth. I guess that means that you have had a pretty tough time this year, really, with the rotation out of growth companies and into more value-focused companies, which I suspect would be more or less precluded from your universe. You've lost around about 8% over the past 12 months and around about 18% year to date. So what have been the key factors that have really hit hardest for the trust, would you say?
Well, I think you've nailed it.
Oh, sorry.
But I think what I'd say is, there are two parts to the return for an investor in Impax Environmental Markets. One is what's happened to the NAV, and the other one is what's happened to the premium discount on the trust. And when it comes to the NAV, it really is, it's what you said. There's been this huge rotation out of growth and into value. We have some, but not a huge amount of value exposure, because we're talking financials, you're talking energy, sectors we don't have a lot of exposure to, but we are overweight in growth and in quality, and both of those areas have been out of favour. So that's the main driver of the NAV, together with small and mid caps underperformance. Volatile environment. But if we look at the second ingredient being the premium, obviously we've had several strong years of performance, a lot of focus on environmental markets in investors' eyes. And that drove a strong premium in the trust, which was kind of double digit, even heading towards the mid-teens in the middle Q2, Q3 last year. So we closed last year at a 10% premium, but with volatile markets and the rotation and risk off, that premium has disappeared basically. But we do want investors to be very clear that the board and we as managers, are determined to stand behind the vehicle. We were buying shares back on the day Russia crossed the border into Ukraine. So sorry to kind of lead into that, but we will not let a material discount emerge in the trust, so investors don't have to worry about that.
Right. Okay. Have you taken steps to reposition the portfolio then?
We'd spent a lot of the last 2 or 3 years repositioning the portfolio. We've been looking to diversify our cyclical exposures. We've been looking to find more defensive opportunities to get us from a very pro-cyclical portfolio to something that was more balanced.
Can you give me some examples?
So on the cyclical opportunities, we found new technology investments in areas like the industrial software arena. So software for product design and also management of manufacturing, also monitoring capital goods in a predictive maintenance arena as well. So across the industrial value chain, those kinds of software opportunities were new. On the defensive side of things, we added a good chunk of natural ingredients companies, which are quite often selling into consumer staple type markets. And so they're fundamentally more defensive in nature.
Yeah.
But we really believe in a transition that's going on away from synthetic and oil-derived ingredients towards these natural ingredients as well. So they're defensive, but with a strong growth opportunity within them.
Have you been able to take opportunities then in the last few months to buy stocks at attractive prices?
What we have been doing is, so everything that I said about the activity of the last few years, last couple of years, left us with a portfolio of 63, 64 holdings. And we wanted to consolidate back to 60 to keep it decently focused. So in the current arena, that's what we've been doing. There are a few names that we decided were subscale and that we wanted to move on from. And we're finding a lot of opportunities to top up on some really compelling quality defensive growth names, but with a very derated valuation, back to a 10-year average level, right. Something like that. So we're broadly happy with what we had, but we're still making some incremental additions to existing holdings.
Could you give me any examples of the ones you've been topping up?
So in the UK, I think Spirax-Sarco and Croda would be two examples of that.
What do they do?
Spirax-Sarco is a steam specialist.
Okay.
So they send an army of engineers around to an industrial facility who does a study to help them understand their use of steam and make it more efficient. And then they sell them the widgets to realize the plan, which is a repeat business. It's a market that Spirax dominates. It has been through an aggressive derating and ticks all of the boxes I just mentioned in terms of much more attractive valuation and a strong long-term growth story. Second one is Croda, which is one of the natural ingredients holdings we were talking about. They serve, in particular, personal care, but also healthcare markets, and with a growing focus on kind of natural ingredients in the mix. So same kind of thing, defensive markets, but kind of strong franchise and growth prospects.
Just broadening out the discussion a little bit, would you be able to give me an idea of where you sit amongst your competitors? How do you differentiate yourself within what has become quite a competitive investment market over the past 3 or 4 years?
It's definitely true that it's a much more competitive market. So there's lots of sustainability and ESG funds out there. And it's quite bewildering for everyone and for the investor on the street.
Yeah, absolutely.
But I'd say there's not a lot of specifically environmental funds. So if you're wanting to invest in environment specifically, if you want it to be pure play exposure, the trust has 80% weighted average environmental content of revenues. If you want it to be in a kind of small and mid-cap environment, so these smaller, fast-growing businesses, then actually there's very little out there that's doing specifically that. Probably the closest fund to something that does something very similar to us would be Jupiter Ecology. But if you look at a lot of the other ones, they're either larger cap or more broader sustainability, including healthcare and other sectors. So I think it's a fairly unique product if you're looking at specifically at the environment.
And there's no ETFs that would replicate the kind of thing that you're doing?
Not that I have had a lot of contact with.
No.
And to be honest, our view of this is that environmental markets is an area that really needs active management and just isn't suitable for ETFs.
Yeah, absolutely.
So I think the product is quite unique, but also how we differentiate is by virtue of 20 years of long and strong performance track record, and it's the team at Impax with 48 people doing nothing but looking at these sectors. So that's our differentiation.
The trust soft closed a couple of years ago on the grounds of capacity. Could you explain a bit more about why you took that decision and what difference it's made?
Yeah, so we soft closed the specialist strategy, of which the trust is the flagship vehicle, 2 years ago, because we wanted to not take on too many assets that would mean that we couldn't deliver to our investors what we'd always given them, that we'd somehow be having to run it differently and we'd compromise on performance. So it was that determination to stay true to what we started 20 years ago. So we basically said no more segregated accounts, and we said no more inflows into open-ended vehicles apart from existing investors, and there's been some constraints around share issuance by the trust, so where they have a 10% allocation per year. So those were the steps we've taken, and I think it's worked. It's allowed us to keep the portfolio at a 60 holdings. We've still got good maneuverability within the existing portfolio and making new investments. And so I think we spotted this decently in advance, and I think it seems to be well received by our investors as well.
I mean, presumably, given that you are focusing mainly on small and mid-cap companies anyway, you really can't afford to get too much bigger. Running a focused portfolio, is there a point at which you're going to have to stop growing? I mean, that doesn't seem to quite make sense. What happens if the trust picks up again, as it hopefully will do in due course? If it keeps on growing, how are you going to manage that? Well, continuing growth.
Hopefully we've spotted it early enough and took the necessary measures that we're not going to need to get to that kind of hard close arena. And obviously, capacity is a breathing number with markets and the opportunities that you can invest in. And so that's our hope, is that as these markets are growing, that will allow enough incremental capacity for the constellation we're in now. But we will make sure we do what's necessary to keep giving our investors what they join for.
Is there an argument that small new competitors are going to be better placed to invest in these equally new small companies as in what is a very rapidly evolving arena? Are there areas of the whole environmental market that you're going to find difficult to access on the grounds of size that they will be able to access?
I'd say we don't have any issues accessing the parts of the market that we want to access.
Right.
If that makes sense. I mean, a big learning point over the years was not to invest in very early stage, unproven, unprofitable, very small companies. And that's been a good thing in the last 12, 18 months as those kinds of investments have really underperformed in the market. I would say that for the smaller end of the scale, at $250 to $500 million, we're more likely to need an event to get a position in these companies. But typically at that size, they're needing to raise money to fund their growth anyway. So we're still managing to add positions in this category by getting to know the company, building a relationship with management, understanding what they're doing, and then when there's a fundraise, that's our moment to get involved.
Right. Well, just out of interest, how much time do you take in actively engaging with companies?
It's a huge part of our work. Obviously, in small and mid caps, management is even more key than in a kind of larger cap environment. We spend a lot of time doing our research up front to decide it has the quality to go on our approved list and then to go into portfolios. The ESG analysis is one of the building blocks of that research, and it generally flags up things that are good and things that could be better in the business. So it's definitely part of our work to engage with management to help them on that journey. And sometimes they come to us and say, there are so many people coming and asking us different questions around ESG, so we can help them decide what's important, measure it, set targets, and set up a plan. So yes, there's a lot of engagement that goes on.
Which emerging trends would you personally say are the most exciting ones looking ahead for the trust? Things are obviously changing all the time, and there are going to be new opportunities opening up, no doubt, in years to come. But at the moment,
I'd say that the best opportunity is the portfolio itself, because in this rotation we've had a massive derating of the portfolio from mid-20s next 12 months PE down to 18 times at the end of June. So we're back at a long-term average multiple for a strategy where the long-term growth outlook has never been stronger. And despite earnings delivery that's been very solid through what's been a very challenging period. So we're positive on the portfolio overall. When it comes to incremental opportunities going forward, the circular economy we've kind of addressed. That's definitely early days and lots of opportunities. Secondly, obviously we're on this journey to net zero emissions, but we're also looking to reduce our reliance on Russian oil and gas. That is meaning faster growth for renewables. But I think there are some areas that are going to see outsized growth. So we need to, in particular, decarbonize heating, accelerate the uptake of heat pumps, and just reduce our use of gas across residential and industrial markets. So I think that's an area that we're going to see more opportunities and have more exposure to. Another one would be climate change adaptation. No one is in doubt that we are in an adaptation scenario where we're having to adapt to the consequences of a more volatile climate. And after a string of years of events, we're starting to get good visibility of where the opportunities are around that. So backup power is an obvious one, keeping the lights on when the grid is down. We're also looking at building materials for more resilient buildings. What are the roofing membranes and materials that don't get ripped off when you're in a storm or hurricane environment? So I think adaptation is another area that we'd like to see more investments in.
Given the temperatures of the past week or so, is there work going on to try and find new ways to keep buildings cooler, to keep environments cooler?
I think it's going to take some things are going to need to be rolled out more intensively. So if you think insulation is probably the biggest thing that people could do, double glazing, making sure all buildings have that. Those kind of opportunities will immediately help manage temperatures across the housing stock. But more broadly, we need to reimagine how we design cities and towns. You have to have more consideration of shading and kind of planted areas that just make these temperatures more manageable. And we need more cooling, which we've not needed in the UK before. But heat pumps, more efficient HVAC, all of these areas are going to be part of the solution.
One last question, John. Are there any areas or individual aspects of the environmental arena that you would never invest in?
I think never say never. These markets have, they evolve sometimes quite rapidly. We're lucky to be often on the beneficiary end of industrial upheaval, electric vehicles, the drive to eliminate plastic waste, all of these upheavals we've been on the beneficiary side of. So you need to keep an open mind. So I think earlier stage opportunities would be things like hydrogen, which people will probably know we've been a bit cautious on the valuations and what's the real size of markets for hydrogen. So I think after the sell-off of those kind of growthier valuations, that's an area that, having had zero exposure to, that we're keeping tabs on.
Yeah. Well, it's a very exciting area to be involved with, and I'm sure there must be never a dull moment there. So thank you very much for taking the time to come in and talk to us today.